Hello and welcome to today's Revenue Recognition webinar. We are focusing on the new Revenue Recognition Standard, and today we will be talking about industry considerations and cross-functional implications. So this is a topic that we received a lot of questions on throughout our webinar series with FEI, so we're pleased to bring you a great list of speakers who are going to be talking on this particular subject today. So before we get started, we will just go over a few administrative items about the webinar functionality and then the CPE process. So I did want to let everybody know that you can download a copy of the presentation via the resources area in the attendee screen of the webinar, and it is a PDF copy of the presentation, so you can print it out and take notes. During the webinar, you are welcome to ask questions. This is a hot topic right now, especially with the announcement from the ISD last night about their agreement with the delay in the effective date of the standard. So go ahead and send in your questions. We will be monitoring them, and then we have dedicated time at the end of the webinar to answer as many questions as we can. If you are having trouble hearing the audio through your computer, a separate phone line is available. We've set up lines for attendees in the U.S. and Canada, and then if you're dialing in from outside of the U.S. and Canada, there is a separate international line that you can use. Our preferred method is for you to listen to the webinar through your computer, but we realize that doesn't work for everybody, so you are welcome to use these phone lines. We will be offering 1.5 CPE credits for today's webinar, so in order to be eligible to receive these CPE credits, you must answer at least 4 out of the 5 polling questions. This is a NASBA requirement, so we will be administering those throughout the webinar. They will pop up in the middle of your screen where the slides typically are. Answer them, hit submit, and then your answers will be recorded. You will receive your CPE certificate approximately 2 to 4 weeks after the webinar date. So one of the questions we often receive is, will my CPE certificate be available for immediate download after the webinar? And the answer to that is no. We will email you your CPE certificate from the Protiviti CPE administrator. In the resources area, you are able to download a copy of the presentation, as I mentioned, and then we have also made available to you a web page on Protiviti.com where you can download the various flash reports that we have written on this particular topic, and you are able to access the recorded versions of the prior 4 webinars that we have done in this particular series. So we have been offering a webinar series in conjunction with FEI. So I just wanted to point out on the FEI webinar or website, they do have a revenue recognition resource center. So if you type in the URL of www.financialexecutives.org/RevRec, you are able to directly access all of the revenue recognition resources they have made available as well. The first presenter I would like to introduce comes from Walmart, and it is Jeff Andrews, who is the Senior Director of Accounting Policy at Walmart. He leads Walmart's technical accounting team and is responsible for the global accounting policies, technical accounting requirements, and other accounting policies related projects. And Jeff will be joining the discussion to really talk about how this particular standard impacts the retail industry. Our next presenter is Curtis Barron, who is from Crane Co. He is the Vice President Controller at this particular organization, and his responsibilities include internal and external financial reporting, corporate accounting, and coordinating the external audit efforts with Deloitte & Touche, among various other responsibilities. And Curtis will be talking about how this particular standard impacts companies like his who are in the industrial product and manufacturing arena. Mark Flournoy is the Vice President and Corporate Controller and Chief Accounting Officer at Intuit, which is a company that primarily services the technology industry. So his responsibilities include the general accounting function, internal and SEC financial reporting, corporate governance, internal controls, among other responsibilities. So he will be joining the discussion on how this particular standard impacts the technology industry. The next presenter we have is Pete Graham from SAP. He's the Director of Financial Solutions and Mobility at SAP, and he is actively working with customers as they tackle the revenue accounting standards with SAP revenue accounting and reporting software. So he will be able to give us a good perspective on how this particular accounting standard is impacting organizations' technology infrastructure. We do have 4 Protiviti presenters today. So Russ Collins is the first one that I'm going to introduce. He's a Managing Director out of our Dallas office, and he is going to be joining the discussion on the retail industry along with Jeff. Steve Hobbs is our second Protiviti presenter, and he is a Managing Director out of the San Francisco office, and he will be primarily focusing on the discussion of the cross-functional impact, and will be joining the discussion with Pete Graham from SAP. Gordon Tucker is a Managing Director with Protiviti, and he has over 30 years of experience, and he leads our technology, software, internet, and life sciences companies. That's where he specializes, and he will be joining the discussion with Mark from Intuit. And Chris Wright is the final Protiviti presenter that I will introduce. He will be Chris is based out of our New York office. He's a Managing Director, and he will be focusing on the industry discussion on industrial products with Curtis Barron from Crane Company. So at this time, I'm going to just give you an overview again of where you can gain access to the past 4 webinars that we've done with this series with FEI. We have had the pleasure of working with them since November last year on this particular topic. So in the resources area of your screen, you'll be able to access the prior recordings of the 4 webinars if you weren't able to attend them, or if you need a little bit of a refresher. And at this time, I'll go ahead and turn it over to Russ to get the conversation started.
Great. Thank you, Lark. Good morning, good afternoon. Really appreciate all you joining, and we're real excited about today's webinar. Today we're going to discuss briefly just some highlights, updates of the new standard, and spend a little time on discussing the potential cross-functional impacts across organizations, and some steps that you may want to consider if you haven't started already. And then the bulk of our time will be discussing industry considerations and insights, and we'll hear from Protiviti industry leaders and, more importantly, great industry panelists that you just heard. So looking forward to that. And then at the end, we'll have time for some Q&A. So let's get started. So by now, everyone knows there's a new standard out that came out of May of 2014. We've been doing this 4 other times, and I think it's still, a lot of people haven't even read the standard, so that's always our first recommendation. It's 150 pages, of which 70 of them are great examples. So if you haven't read that, obviously that's a great place to start. As Lark alluded to, and by now most people know, even since our last webinar, on July 9th, the FASB approved a 1-year deferral, which we already knew that was kind of in play. And then she also alluded to, just hot off the press yesterday, the International Accounting Standard Board also followed suit. And they are delaying it at a year as well, which gives companies time to think through this, which is what we hope you'll appreciate by the end of this webinar. There's things to consider, like the transition approaches. There is a retrospective approach where you would have to go back 3 years when you do become effective, which would obviously take some time, or there's a cumulative effect. And again, decisions to think of. The overall standard, just to level set us, was to achieve a single comprehensive revenue recognition model, and so thereby removing all existing industry-specific guidance to be a little principles-based. And so all previous industry-specific guidance will no longer be applicable. So that's a big change, as well as it really does expand the qualitative and quantitative disclosures. And we've spent past webinars kind of discussing the nuances. Even though it's been released for over a year, it's being delayed, there's still uncertainty on the impact, and I think we'll appreciate some of that even today. And to kind of help the FASB and the International Standards Board, last June of 2014, they created a transition resource group, or a TRG. And this is a group of practitioners, auditors, users of financials across various industries, geographic locations, public and private, really to kind of help the FASB to address issues. So this TRG group doesn't issue guidance, but they're meeting to discuss and inform the FASB about potential implementation issues. And so there's still uncertainty in various areas, and the best way to stay up on that, if you want to on your own, is through the FASB website, so FASB.org. And then the core principle, I won't go into that. That's straight out of page 2 of the accounting standard, which tells you what the core principle is, as well as the 5 steps that most of us are starting to get more and more familiar with. So the deferral, just to get us all on the same page, originally for public companies, this new standard was going to be effective for years beginning after December 15, 2016, or normal calendar companies, think fiscal 2017. So that's been delayed a year, so that now it's going to be for annual reporting periods starting after December 15, 2017, or 2018. And again, that will include interim periods. So if you apply fiscal 2018, just to remind us retrospectively, if you apply it that transition way, you'd have to figure out the previous 2 years at a minimum what the impact is. One thing that's not noted here, but companies are permitted to elect early to adopt, basically go ahead and stick to, if they wanted to adopt in fiscal 2017, the original effective date, you are allowed to do that. And then for private companies, they were always kind of a year behind public companies, and that's still the case. So most likely, unless they early adopt as well, they will be starting to implement in 2019. So what does the deferral mean? Kind of our message point. One, it shouldn't be a great surprise. We knew earlier in the year that this was being proposed. A lot of people in the industry were expressing, questions about how this is going to impact, needing further guidance. And so the FASB listened to it and have delayed that 1 year. And a lot of companies already had that in mind as they were looking at this, and so it's not a surprise. The second message of what does it mean is, quote unquote, full steam ahead. As you're going to see today, and you may already know, the implementation of this new standard, for different entities, it could be a significant undertaking. And, so time is going to be needed to fully assess the impact of the guidance and implement the necessary changes across the company, processes, controls, systems, possibly contracts. Take the time to also say, hey, are we going to early adopt? What's my transition approach going to be, a retroactive or a cumulative, if you will? So don't let that delay further lead to further procrastination. And our third point, look, half the year is already gone. So time flies quick, and let's take advantage of this deferral. So that's a brief highlights, updates of that, and we'll get into some more of the accounting as we move forward with that. But Lark, I'm going to hand back to you for poll questions.
Thank you, Russ. So we are going to do our first poll question. So it should show up in the middle of your screen if it hasn't already. Just give it a few seconds. And what it reads is, have you read the new Financial Accounting Standards for Accounting Standard Update number 2014-09, Revenue from Contracts with Customers? It's the new revenue recognition standard that was issued on May 28th of 2014. So we have a pretty simple options for you, yes or no, but it's on my to-do list. It's an important standard to read if you haven't already. So we'll just give everybody about a minute to go ahead and answer that. And then while you're answering that first poll question, I did want to remind everybody that we will issue a total of 5 poll questions throughout the webinar. So you must answer at least 4 out of the 5 to actually earn the at least 70% requirement established by NASBA in order for you to receive your CPE certificate. So that is one of the requirements of attending a webinar and earning CPE, is that you do need to participate in the poll questions to receive that CPE certificate. And we will be issuing CPE certificates for 1.5 CPE credits today because we are conducting a 90-minute webinar. So it looks like a majority of the attendees today have answered this particular polling question. So we'll go ahead and move on and show you what the results were. So the answers are yes, 21% of you have read the standard, and then 78, almost 79% of you said you haven't, but it's on your to-do list. So now that we have some firm guidance from the FASB on the dates, it's probably a good thing to start doing. So go ahead and we'll move on to our next polling question, which is asking, now that the effective dates for the new revenue recognition standard were extended, does your organization plan on moving ahead with the transition strategy in 2015? So the answers are yes, no, or don't know. So go ahead and select the most honest one from your perspective. So we'll see, and then we'll show everybody the results to show the audience where the audience is with this particular topic. There have been a number of articles and in publications out there recommending that companies do continue implementing with or starting with their transition strategy, even though the date has been pushed out a little bit because there is a lot of work to do. And that's something that we've been talking about on this particular webinar series, and we will continue to talk about today as well. So we'll go ahead and we will close out this particular polling question, and we'll show everybody the results like we did on the last polling question. And it looks like 23, almost 24% said yes, you're going to go ahead and move on with your transition strategy within 2015. 22, almost 23% said no, and then a little over 53% of you said you don't know. So that's a very good, honest assessment of where this particular audience is today with the new revenue recognition standard. So thank you for participating in our polling questions. We will issue 3 more throughout the webinar. So Steve, I will go ahead and turn it over to you.
Thank you, Lark. I don't think those are surprising. I think it confirms a couple of things. Number one, I think there was a lot of us who were hoping that the standard might be deferred even further, that it might go away, or it would be deferred until at least we retired in our various professions, so we wouldn't have to worry about it. But it sounds like it's here to stay, and so the fact that we haven't spent many of us may not have spent a lot of time with this. We don't know what we're going to do in 2015. Tells us that there's still a fair amount of uncertainty, and a lot of companies are still thinking through what this really means to the organization. This slide simply talks about a roadmap. So just like any other significant strategic initiative in an organization, we believe this transformation or this transition to the new standard should be carefully thought through. And so this simply shows the cycle from all the way from assessment and diagnostic of what the implications are on not only the accounting and the reporting, but what does it mean to the other parts of the business. And then there's the transformation activities itself. And for companies that are impacted by this, it's really important that as you go through the transformation, that you establish good processes and principles and methodologies such that this new process will work well for you quarter in and quarter out as you go through, and it will not impact your ability to accurately and timely file financial information, nor will it impact the accuracy of that information. And we are talking about revenue here, which is a very critical financial statement line item that we get. Companies want to make sure that is right. So at the beginning of that cycle was the diagnostic and analyzing what this might mean to you. And one of the things we suggest is whether you're in your formal planning, you use a formal diagnostic tool, which we'll talk about an example one or some formal assessment, that you consider really the broad implications that this standard might have. For many companies, figuring out the accounting and the reporting and getting the accounting model right might likely be one of the easiest parts of this transformation. And the reason for that is that the implications will be very clear what the accounting is, but all of a sudden companies will soon find out they need new data. They may want to restructure their pricing and their contracts. They're going to begin to think about the processes, how they're going to use technology to enable this transformation. This potentially not only impacts the revenue line item in the financial statements, but also potentially can impact commissions and other costs that are based on revenue. And so all of a sudden the implications of this, it's much more far-reaching than simply the finance and accounting group. So we really think that companies, when they are scoping this and analyzing this, that they carefully think about not only how does this impact the finance and accounting group, but what are the other things that are going to be impacted by this. So at Protiviti, we use what we call the 6 elements of infrastructure, which is a way that we believe companies, when they're planning to thoughtfully prepare for a transformation or a significant activity. You can see across the top, that's looking at the impact on methodologies, policies, processes, systems and data, the reporting, and then the people element of this. And as you can see, for each of those areas, they're related to this, specifically to this revenue recognition standard. We've listed a number of considerations that when you're planning and diagnosing what this might mean to the organization, that you're giving some careful attention to these items and considering them, looking at this in a holistic view. So within those considerations that are running across the top of this screen, you begin to see certain issues or potential issues that might lie within various departments, functions across the organization. As I indicated earlier, for a company to say this is simply an accounting and finance exercise might be a mistake. And as you can see, there are potential implications across a number of functions. People's compensation or commissions might be impacted by this. There may be some training that needs to go on, so the HR organization. Certainly you can see accounting or finance, it's a very important, it will impact them. Companies also need to be very considerate of the fact that this not only changes potentially the way you've historically recorded revenue, but it also could impact how revenue is forecasted and budgeted. And for public companies that are providing guidance to the street related to revenue and other key metrics and other financial information, companies will need to think through not only how do we get the data to report revenue historically, but let's make sure we put data and processes in place in the related systems to make sure we have the right information to accurately forecast revenue going forward. For companies that have internal audit functions or have Sarbanes-Oxley compliance, the area of controls and how those controls are going to change, particularly as it relates to new data requirements where that new data is being captured. Those are considerations. The Treasury function will potentially could be impacted. This could impact financial results. It could impact debt covenants, other types of reporting that Treasury might do as it relates to planning and reporting to creditors and investors and others. One of the things we've seen with a number of our clients and other companies is when a company finds out potentially that revenue could be recognized earlier, which for many companies that will be the case under this new standard because they've had bright lines that have caused revenue to be deferred. There's there's a strong potential that you could have revenue recognized earlier. And if revenue is recognized earlier, obviously the folks that are compensated based on when revenue is recognized are very interested in that. The other part of this is that many companies are looking at how they are pricing and bundling products and services to see if they should consider changing those because unfortunately for some of those companies, the accounting may have been driving how the terms and conditions were laid out and the related pricing in the contracts. So as you can see, this has some far-reaching implications. The IT part of the business will also be important. This will be something that will likely be added on their laundry list of requests from the other functions in the organizations, whether it be parallel processing or additional capacity or getting access to data. And then the operations group certainly could be impacted by this since they are having face-to-face interaction with customers and product managers, etc. And then the legal group and the tax reporting implications. So I think I've drained that enough, but this purpose of this slide was to give you, as you're thinking about how this might impact your organization, let's think about what are the elements of infrastructure we need to consider beyond the accounting and reporting, and let's begin to think about how this might impact the other parts of the organization. Certainly, you've got to get the accounting and your accounting model and reporting. That's the linchpin for the diagnostic. But you also got to be thinking about beyond that, what that might mean to the organization. So this is a roadmap of a diagnostic process. So just like any other diagnostic or formal assessment that's been done, you can see we're looking at specific items or elements that need to be considered, whether they be accounting elements or infrastructure elements. Looking at the current state, understanding how it might be impacted by the standard and defining what that future state would look like, performing a gap analysis, coming up with a recommended approach related to the change, and then from there begin to develop a roadmap around cost and effort, who's responsible, level of urgency, so you can begin to prioritize those items in a formal way that you can execute against. Within a diagnostic, you might see the following items that would be looked at as it relates to a diagnostic. So that's everything from determining the transition method to doing the gap analysis of the 5 steps out of the standard. So a pretty detailed analysis there. Looking at the steering committee, establishing a PMO office, what are the critical accounting policies that need to be looked at? How does this impact controls? And then what other financial reporting, both internal and external, are affected by this? So this is simply an example of a sample diagnostic for establishing a steering committee. So as you can see, you've got the item, you've got the various elements of infrastructure, you've described the current state, then you begin to ask the diagnostic questions, and if we were to expand this to the right, you would see that we would have the results of the gap analysis, what the differences are, and we would be able to take those and develop a work plan, a project plan, which we could use internally. We could also use it as it relates to accounting and reporting. It would be the roadmap that we could use to discuss with our external auditors, as they'll be a key stakeholder to this process. So Pete, you've been working with a number of companies that have been challenged with this. You've got some pretty deep experience here. Can you share for us maybe some of these key learnings and provide some insights on lessons learned or best practices for our listeners as they deal with this transformation and what this might mean to their organization?
Sure, Steve. Sounds good. I mean, what we've seen across probably a couple dozen projects so far is that you definitely want to get the technical accounting assessment done up front, and it's really important to get that done in advance, or at least start part of it in advance. I mean, there's a lot of organizations you could have a lot to go through, and so you might have to do it in waves. But certainly that's kind of our number one lesson. I'll give you an example. We have several customers implementing, as I said, and two of them came to us almost at the same time late last year into early this year. And one customer pretty much had those requirements nailed. They weren't quite 100%, but they were definitely well on the track, and they decided to implement. And that project has gone very smoothly in terms of even being ahead of schedule, because they were actually didn't have any discussions, or it was very clear what needed to be implemented, and that was very easy on the project team. The other customer came with requirements that were actually much less clear. They didn't really have a good collaboration between the IT side and the business side. Even though the business was involved, the collaboration wasn't as good. And that customer, the project is still ongoing, and I just use that to illustrate that definitely we do see a difference, that if you jump in right away, there's certain things you can get done on the system side, but really when it comes down to it, you really got to get those accounting assessments done up front, or in advance in kind of an iterative fashion. I'll talk about that next. So the other thing we've seen is that the revenue accounting topic, because of the new regulation and the way it could impact accounting policies, and that flows through, you might not know all of your requirements up front, and so this is hard for IT. Also, the standards are gray, right? There's some choices that you get to make because this is principles-based and not very prescriptive, typically like a US GAAP standard that we're used to. So if you go to your IT counterpart and you say, look, I need a system that can do X or maybe Y or maybe Z, they get a little nervous. It gives them a little heartburn. But that's the nature of the regulations and the timing we have. So what we also have seen is that a lot of our customers are having much better success if they kind of do the project in waves, meaning that they'll take maybe what would have been maybe a larger proof of concept or project, and they kind of split it up into smaller ones. They may implement maybe the integration or the order parts first, and then do maybe some of the contracts. Maybe out of a portfolio of revenue contracts, they have thousands or tens of thousands of contracts, but they may have 50 types. Out of those 50 types, they might focus on 5 or 10 types and get those assessed, and then move those over to IT so that IT can start working on them and then move on to the next. So that's kind of what we've seen, and that seems to have worked quite well. Another lesson we've seen is that it really takes very close collaboration between IT and finance and accounting, and that is almost a daily collaboration. We've seen this in projects, we've seen it in workshops, and so now when we do a workshop, we actually recommend and we almost insist that the customers bring their IT counterpart with them. If they're from finance, if they're from IT, they bring their accounting or finance person, because they really get more productivity and benefit out of any discussion, because you can resolve those issues right away. If an IT person has a question about the requirement, the accounting person or finance person can really step in, provide the clarifications that needed, and hopefully make it very, very consumable then for the IT team to then figure out how to implement or address that requirement from the accounting side. Another thing that we've seen is that some of the customers, and I'm seeing slightly or kind of an uptick in this trend, is that we're running into several customers where their current accounting standards are in place, but they might not have a system that's automating those accounting standards for revenue as much as they would like. And so we are seeing a little bit uptick in customers saying, well, let's take the new compelling event of this new standard. Let's look at our current process, implement a new system, and then be ready for the new accounting standards. And our product can help you do that, and that's what customers are starting to take advantage of that strategy. And so that's another thing to keep in mind is to, potentially you could have a process now that has some pain points in it, and you can use some of those pain points as an opportunity to start now, get parts, building blocks of your system in place, and really start moving forward and get ready for the standard a little bit earlier, at least from the system side. The other thing that we've talked to customers about, especially for the new standard part, and our solution, SAP Revenue Accounting Reporting, is built from the ground up for the new steps, the new 5 steps. And so we get a lot of customers really focused on those 5 steps. But there is a parallel reporting challenge that is going to come in here, and there are some disclosure requirements that come along with that. So the other kind of lesson we've learned is don't forget about kind of the bigger picture, right? You are going to have to figure out your transition method. You are going to have to figure out if you want to do kind of full retrospective or in parallel. And those decisions are going to impact your overall parallel reporting strategy. That will then have a certain system impact or not. I mean, it could be a light impact or it could be kind of a heavy impact, but you want to make sure you understand that so that it becomes part of your planning. Again, I guess that's the quick final thought is, and again, I think Steve may have mentioned this before. I mean, we did get a delay in the standard on both the U.S. side and the international side, but I would recommend getting started on that accounting assessment as soon as you can if you haven't already. And with that, I will turn it over to Lark for the next poll question.
Thank you, Pete. So we will go into the third polling question. I know some of you had questions about this flashing up on your screen quickly. So that was, I think, a technical glitch. So we're actually administering the polling question now so you can answer it. So hopefully what you see on your screen is the polling question that reads, do you believe the new revenue recognition standard will have a cross-functional impact on your organization? So the options are pretty simple, so yes, no, or don't know. So go ahead and give us an honest assessment of where you think this is going to or how it's going to impact your organization, especially from a cross-functional perspective. This is a topic that Steve and Pete just talked about extensively. It's been something that Compliance Week has reported on, FEI, a number of different accounting journals, to really keep in mind that this is not just a technical accounting standard. So that's kind of a little different than some of the other standards that have come out. And it's just really important to get that holistic assessment of what and how this is going to impact the organization and who within the organization needs to be involved. So a number of you have answered this particular polling question, and just as a reminder, this is the third of the 5th polling questions we will administer today. So we'll go ahead and take a look at the results before we move into the 4th polling question. And this particular answer is yes. That was an overwhelming response on this question. Over 70% of you said yes. Almost 10% of you said no. And then, there are about 20% of you were really honest and said you don't know. We don't really know how this is going to impact our organization. And that's really good to say. You don't know. We're really trying to figure it out. And that's something that we're all doing together. So we'll go ahead and administer the 4th polling question right now. So what you should see on your screen is, has your organization started to assess the impact of the new revenue recognition standard on your organization's Sarbanes-Oxley compliance process? So this is an option or a question that might not be applicable to everybody. So we did give the option of not required to comply with SOX, but if you are required to comply with SOX, go ahead and select yes or no on whether or not you've really started thinking about how this is going to impact the Sarbanes-Oxley compliance process. This is something, when people were registering, we did see this question come in, and on our past 4 webinars, people have just asked us point blank, is this going to impact my SOX compliance process? So we know it's going to be a big issue. A lot of organizations are trying to figure that out. And it is something that we hope to address in an upcoming webinar, because we do think it will be something that a lot of organizations really have to sit down and really examine on a go-forward basis. So we'll go ahead and take a look at the answers for this particular polling question. It's an even split, about a third of between yes, no, and not required to comply with SOX. So a little over 35% of you said yes, we started thinking about it. 33% of you said no, and then about 31% of you are not required to comply with SOX. So that's a good assessment. This is a new topic. People are going to start thinking about it this fall, and really how is this going to impact organizations on a go-forward basis. So thank you for answering the first 4 polling questions. We will have a 5th one later on in the webinar, and at this time we'll go ahead and start talking about the industry considerations. So I'll turn it over to Chris Wright.
Thank you, Lark. And as we move into industry considerations, we thought it would be appropriate to dive into some of the basics of the standard to provide context for what you're about to hear from each of the company spokespeople who are working on these projects in their own organizations. The new standard, as you can see on screen, requires entities to identify contracts with their customers in a variety of forms. They are to identify what performance obligations are included in those contracts, determine the overall transaction price, and allocate that transaction price to the performance obligations they've identified in Step 2. And finally, recognize revenue when those performance obligations are satisfied. For those of you who are public companies, this overlays neatly with SEC Staff Accounting Bulletin 104, persuasive evidence of an arrangement being consistent with identifying the contract, fixed or determinable pricing being identifiable with Step 3 of determining and allocating the transaction price, and delivery and acceptance or performance being consistent with Step 5. What we're seeing companies as they dive into this encounter is that Step 1 is relatively straightforward. Step 2 is somewhat difficult depending on how bundled or unbundled their products are. Step 3, again, straightforward because it's the total transaction price, although there could be contingent issues. Step 4, again, difficult, allocating one transaction price to multiple elements if they exist. And Step 5, easy when Step 4 is done and impossible when it's not. And so we're seeing companies approach this issue with those 5 steps in mind, as they should, and that's what they've been encountering to date. When you think about some of the potential significant accounting and reporting changes, as I mentioned earlier, multiple element arrangements where companies have to provide a series of promised goods or services are a challenge in terms of allocation of transaction price and then recognition of the performance obligations as they're satisfied. Using observable inputs for standalone estimated selling price is an area where it should be easier, especially for technology companies who are used to struggling with vendor-specific objective evidence. Variable consideration, which historically most companies have had to wait until they're absolutely sure they're going to get it. Companies with an ability to estimate where they stand and a track record of being right may be in a position to recognize revenue sooner as they achieve certain milestones based on their experience and how the standard is ultimately interpreted. From a time value of money perspective, long-term contracts are going to require to reflect that. Another subjective area, another decision point would be, well, what's the discount rate you're going to use? And different companies who compete with each other may have different rates and both be right. And so disclosures will be important there. And, of course, the timing of revenue recognition. There may be some entities that are used to recognizing revenue over time who may wind up recognizing it at a point in time instead, and vice versa. Those who are used to recognizing revenue upon shipment of something or delivery of something, they have to recognize it over the life of the service that's implied in whatever that performance obligation is. And so there could be changes there as well. Certain contract costs will need to be capitalized. Historically, those have been expensed, except for in construction type contracts, and that's the next 2 boxes on this page. The construction type contracts and the other long-term contracts, which have historically leaned on SOP 81.1, a 34-year-old accounting standard, may need to start separating elements within those contracts and recognizing them with different margins and at different times than they used to before. And of course, some of the costs that they used to capitalize may not be eligible for capitalization depending on how that fleshes out. Further guidance is expected, and it's actually been coming from the Transition Resource Group on software subscription accounting and whether a right or access has been transferred. Elements in software arrangements, as I mentioned earlier when we talked about multiple element arrangements, VSOE is no longer required, and that's a happy fact for the technology companies. And of course, disclosures are going to be important, as you may have different companies with the same sets of facts and circumstances or similar, have different outcomes and both be right. The footnotes will need to help analysts figure out how to level set that. When you go to notable implications, We believe and we've seen, and you'll hear from some of the speakers and have already heard, that the industries that are most likely to experience the most significant change would be software, obviously, telecom, asset management, airlines, real estate, and the aerospace and construction, those long-term contract type accounting scenarios. But the changes aren't going to be limited to those industries. No one's exempt from at least diagnosing, as Steve pointed out, whether there is a gap. And you may find that there is none, and that should be a group decision from which you can move on to do very little, or there could be a lot. And one shouldn't take for granted, based on a broad industry categorization, whether you think it's going to be a big deal for you or not. And of course, companies with longer delivery cycles and non-standard or complex terms, or where it's not always on your paper but somebody else's, may have different experiences as well. As we get involved in the industrial products industry in particular, and you'll hear from the speaker shortly on that, we've seen certain themes emanate from the diagnostic work that companies have undertaken so far. Whether with rental and leasing arrangements where there were sales and perhaps conduits to create sales, whether those are revenue at a point in time or revenue that's recognized over time. When there are bundled product offerings, for example, where companies are selling service contracts and warranties with products, is the warranty, based on the words of the contract, an element for which deferral of revenue is required, or an item for which a warranty accrual is required, and there will be differences there, as well as how delivery is indicated and proven. And of course, software that's embedded in hardware will drive those companies likely into some of the software accounting that might not be typically considered by them as industrial products companies. I talked about the long-term contracts already, and as the percentage of completion versus the separate elements of accounting that might be required becomes more clear, those distinctions will start to be drawn, and companies will start to have to develop, some of the earlier speakers have said, systems for tracking data differently and producing it in an integrated fashion out of their general ledger as opposed to on the side. For shipping terms and logistics, you have companies that have dealt with in the past, and the accounting is not easy for them now, and it won't be in the future. Consignment, replenishment, bill and hold type arrangements, and they'll still have to satisfy the 5 requirements of the new standard and likely the 4 requirements of SEC Staff Accounting Bulletin 104. And then finally, gross versus net, whether you have principal or agency considerations. Again, those are accounting issues now, but companies are continuing to grapple with them as they apply to the new standard. With that as a backdrop, I'd like to turn it over to Curtis Barron, who's the corporate controller at Craneco. And he'll share with us how they've approached their gap analysis in their multinational and multi-segment environment.
Thanks, Chris. It's a pleasure speaking to everyone here today. As Chris mentioned, as a multinational, multi-segmented, diverse industrial manufacturing company covering businesses ranging from aerospace and electronics to vending machines to a wide range of fluid handling applications, it's important for a company such as Crane to prepare this gap analysis of its various streams of revenue and begin to identify those areas to focus on regarding the new revenue recognition standard as soon as possible. We began our analysis by developing an Excel template, back to basics, Excel template, which we provided to each of our business units. Template was designed to capture information regarding current revenue streams in a consistent manner across all of Crane, despite covering such diverse businesses. We did this by leveraging drop-down menus and categorizing revenues by stream. We broke down our revenue streams into 6 main categories: basic product sales, long-term contracts, extended warranty or maintenance contracts, funded engineering, multiple element arrangements, and then other. The template also included the current accounting literature providing the main elements which allows revenue to be recognized in these various types of arrangements today. For each revenue stream, we asked each of the businesses to provide commentary and notes describing the main elements or trigger points for revenue to be recognized in their specific circumstances today. Based on the breakdown of these current revenue streams and the most relevant elements of revenue recognition, we provided a column within the template identifying those new revenue recognition standard considerations that will need to be addressed, including, among others, Does this revenue stream include separate performance obligations that Chris was just mentioning? Would revenue need to be split among multiple performance obligations? Are there synthetic FOB accounting considerations, such as who bears a risk of loss, etc.? Any variable considerations upon achieving certain milestones? How are modifications to contracts handled? Are discounts offered for repair services? These are just some of the elements which need to be addressed to comply with the new standard that we built into this template. We found that identifying our current revenue stream in a logical way, which can be systematically analyzed early in this process, will allow us to better prepare for dealing with the inevitable change and disruption that this new standard brings with it. We allowed about a month to 2 months, depending on business, for those business units to complete their portion of the template. We then spent another month and a half or so between my technical accounting manager and I reviewing the information that was received from the field. We believe this is really only the beginning of our process, but we believe this approach will help yield benefits that as we proceed down this path of compliance with the new standard. It's not rocket science, but to get ahead of the game is much better than to be behind the 8 ball, is our theory. So instead of sharing a full template, which I couldn't do anyway, because I'm a publicly traded company, I figured I would describe the template. And now I'd like to be able to kind of turn it over to Russ Collins for his thoughts on how the new standard will apply to retail businesses.
Great. Thanks, Curtis. And to help me look at it from a retail perspective, I'm honored to have with us Jeff Andrews, who is the Senior Director of Accounting Policy at Walmart. And so we're going to talk about kind of 3 main topics. The first is I'm going to ask, how is Walmart approaching the implications of the new standard? Then we're going to discuss some of those implications, just so that if you're a retail or restaurant type company, you can put that on your radar. And then lastly, I'll ask Jeff a little bit of what are some challenges he foresees for companies as a result of this new standard. So Jeff, thanks for joining us. First question, how is the little retailer Walmart approaching the implications of this new standard?
Yeah, no, thanks, Russ. I appreciate it. It's a good question, and maybe just a little bit of context. I know a lot of people know Walmart and know about them, but Walmart and other big retailers. For Walmart, we had about $485 billion of revenue last year, and primarily that's generated by selling or buying inventory and selling it either at point of sale in a store or online. So when you kind of step back and you think about it, you think, well, hey, if there's any company this standard might not affect very much, and maybe could just easily get by it is Walmart, because it seems pretty straightforward. But when you really peel back the onion, you realize that it's a much bigger effort than that. We do publicly disclose currently that we believe, based on our analysis so far, that the impact of the standard will not be material to the financial statements. But I got to tell you, internally, we do believe that the level of effort we have to go through to adopt the standard will definitively be a material level of effort for us. And partly what drives that is kind of what Curtis was just talking about. We feel like we have a new standard, all the old industry standards gone. So we've really got to go back through all of our revenue streams and all of our revenue-related programs to identify where we think the gaps are. And to add some more context to that, we're really not looking at it from a Walmart consolidated materiality level, since it's a converged standard, and because we have various public filers in some of our foreign markets that file on IFRS, and we also have a whole slew of statutory filings around the globe that are also in IFRS. We really want to take this chance to kind of determine one Walmart view for all of our revenue streams all around the world, which I think is one of the benefits of the standard. And so the way we're doing that is we're basically reaching out to the controllership of every single one of our markets and our business units, and we're getting the controllership involved, getting their understanding of who they think within their team and within the finance function is really strong and has an understanding of all revenue streams and all the different programs we have that impact revenue. And then we've created it sounds like similar to what Curtis did, we've created a survey that we send out to the teams. They fill out the survey, and the survey that we created is really meant to highlight where we think there's potential, differences between the two standards for retailers. We send it out to them, we accumulate the data, and then we have working group sessions with each of those teams where we sit down with the teams, walk through their responses, and really kind of try and make sure we understand the different programs that have been documented. And from there, we're starting now to make our assessment of what we think that the gaps are between the two standards. So, probably the main point I would make is even though, a retail industry, we definitely have multiple different businesses that we'll have to get into, and we have some banks and other things that are going to complicate the efforts for us. But our general business of retail, even though it seems kind of straightforward from the outside, it definitely is going to take a high level of effort to get this effort completed.
Great. Thanks, Jeff. And you and I have traded some notes and discussed. So this next slide are just kind of some of the gaps, if you will, or potential implications. So we're not going to go through all of these, but just wanting the listeners to know these are some of the buzz areas that will have an impact or need to be addressed. So we're going to highlight a few of those. So let's just start off. Really, I was interested when you and I were talking, kind of as it relates possible implications of this gross versus net considerations. Can you elaborate on that?
Yeah, for sure. I think for us, and I think for most retailers, this is the issue we're really kind of keeping a close eye on right now. And I think a lot of people on the call realize that the standard's still moving, and this is one of the pieces of the standard that continues to be discussed. And actually, I think both boards are currently drafting the new section of the gross net guidance to be put out for comment here, hopefully in the near term. But I think every retailer has some arrangements with their suppliers or with service providers that we have to evaluate from a gross net perspective. So for Walmart, we believe that we have to go back to all those arrangements and reconsider them under the new guidance, which I think a lot of retailers would agree with. But I think bigger picture, there's really two industry-specific type of transactions that we're focused on. One's called pay from scan, which those of you who aren't familiar with it, in retail, it's pretty normal for certain suppliers to come into a store, stock the shelves with their goods, but we actually don't take title to that inventory. The title still remains with the supplier, and then they have the discretion to come in at any time and restock the shelves, put in whatever they want. But when a customer comes and buys a good, we actually take flash title to that good at the point of sale. So there's a kind of a momentary title we hold. And from an accounting perspective, under today's standard, that's actually accounted for as gross, and that's through analysis of today's gross net guidance, as well as there's been previous pre-clearance letters with the SECs and others. So definitely an industry standard there. Under the new standard, when you look at the new language, it actually talks about specifically that if you receive momentary title to something, it might not indicate that you have substantive control, and you might not be considered the principal in the arrangement. So I think as retailers saw that language, we immediately kind of looked at it and said, hey, is this going to change practice? And the same thing goes for what we call drop ship vendors, or when we have online businesses where a customer goes online, buys a good. It's not inventory we have. It's inventory shipped straight from the vendor to the customer. Some of those arrangements are also accounted for gross today, not all of them. But when we looked at that, we said, hey, the FASB and the ISB are saying, hey, this new standard, even though it's drafted and has different language in it, they don't expect it to change practice. It definitely raised our concerns, and it's interesting because at the last FASB meeting the last board's meeting where they discussed gross net, they actually discussed this exact example. And interesting enough, I think one of the facts that they were kind of hanging their hat on was not the way that these programs normally operate, and one of the board members knew that. So during the discussion, they did not come to a kind of final resolution on what they thought. So for our perspective, we're really looking at this right now saying, hey, where are they going to land? What are the final words on the page going to say, and how are we going to interpret that? And not just as Walmart, but I think as an industry in total. So for us, by far, that is the biggest issue we're dealing with today.
Okay, good. Thank you. And then I'm going to combine the next two here, kind of this idea that you all are getting familiar with, if you're not, is this idea of kind of looking at and identifying multiple performance obligations, putting yourself in the shoes of a customer. What are they getting? And so retailers obviously have a wide array of customer incentives, coupons, rebates, free products. Generally, the accounting for the point-of-sale incentives will remain the same, but there's certain incentives that retailers might provide that might give additional performance obligations, like coupons granted at the point of sale. Hey, you bought this much, so you get this off, or future purchase. And then there's also price protection, which gets into variability of the transaction price. And kind of along those lines, one of the impacts I'm hearing, not just retail, but let's say airline industry, are customer loyalty programs where you are accumulating either points, hey, I can get a free product after the 10th purchase, or certain points. So I go in and pay $100, but I, as a customer, I'm accruing some loyalty points, is now having to bifurcate into performance obligations that transaction. So what what are your thoughts for retailers in general in this area? Jeff?
Yeah, it's a great question. I think the just in my mind, customer incentives in general is really broad, like you mentioned. There's just a whole bunch of things that kind of fall into that bucket, and it can relate to a variable consideration or performance obligation question or timing of revenue recognition. So I'll tell you that the challenge on our side, and both from Walmart, I think any retailer, is really getting your arms around all of the different customer incentive programs you have. So obviously we do that today under the current standard, but for the new standard, when we send out this kind of gap analysis and these surveys, that's definitely one of the areas we're focused on, because every one of our businesses has unique customer incentives that they issue, and it's definitely a moving target. I mean, you look on TV and you see every day there's new ads about new incentives that different companies are entering into to try and get people to come into their stores or go online. So the uniqueness of every single one of those programs has to be considered in this evaluation. And yet some of the conversations we have been having internally are definitely around performance obligations and variable costs, and kind of what's the difference between what we do today and what we do tomorrow. And a lot of times we've been able to get to the point where we think, hey, these are pretty similar models. We're not too much different. Other ones we're still looking at, but it definitely it's not something you can kind of take a broad brush approach to. You really have to look at every single program and dig into it.
That's good. Yeah, that I think is going to be a big area, and especially for smaller retailers, they're going to have to look into that. For sake of time, I just want to let the people know, like gift cards and breakage, the new standard discusses that. Right now there's diversity in practice. Some will do this breakage, meaning those gift cards that are never redeemed or part of a gift card's not. And so companies now can do a proportional model where they recognize it as redemptions occur, or a liability model where when the right expires, or this remote, when it becomes remote, that they're not going to redeem that. The new standard seems to basically eliminate the one aspect of recognizing when the right expires. And Jeff, just briefly, you were just kind of saying, hey, this may be a good guy for some companies.
Yeah, exactly. I think when you're following the kind of the remote model, and maybe even some of the other ones, it's possible here it's going to be pulling some of our income recognition forward. And so as we've talked to other retailers, I think that's one of the things they're focused on. And honestly, gift cards, it's all going to depend on the materiality of the programs to you. But one of the things that we've seen also is certain foreign markets, gift cards are a much bigger piece of the business. So if you do have operations or retail operations in foreign markets, it's definitely one of the areas to focus in on, because if the U.S. maybe you don't have a big business of issuing your own gift cards, potentially overseas you do, and it could be more material to their financial statements.
Okay, great. And then on this slide, we will move on from that, but just if any of these resonate with you, there's some guidance in the standard, and feel free to shoot me an email if you want. But last question, Jeff, and then we'll hand off to Gordon here, is what challenges would you like our listeners to be aware of that you think retailers, may experience as a result of this new standard?
Yeah, I think mine are probably pretty generic. I think anybody that's on this call that's going through this process right now is had probably a significant number of challenges, but probably the two that I think right now we're grappling with are change management. So, we're going through this process of doing our gap analysis today. So that means, hopefully by the end of the year, we'll kind of have this population of where we think all these differences are. For Walmart, we're going to be adopting the standard on February 1st, 2018. There's a lot of time between the end of this year and then, and everybody's business is moving fast. There's new initiatives. Just figuring out how to capture and track everything between when you do your gap analysis and to when you're adopting and how that's all going to look is something we're still working on. And essentially you're going to be operating under two different standards at the same time. And I think the other thing that we grapple with is, even though we don't think this is going to be material to our financial statements, we know it's going to have some top-line impact. And because our business partners know that, they are screaming and they want to know immediately, hey, what's the impact going to be? And when we don't know what the final standard looks like, especially when it comes to gross net and some of these other things, it makes it kind of tough to discuss with your kind of non-accounting counterparts why we can't give an answer yet and why it takes so long. So that's definitely been one of the frustrations, but something we're trying to work through.
Great. Thank you, Jeff. Really interesting stuff. So at this time, I'm going to hand off to a fellow managing director out of our Bay Area, Gordon Tucker, who leads our technology, media, and communication industry. Gordon?
Hey, thanks, Russ. Appreciate it. So it's been an interesting call so far. I think the polling questions in particular have been interesting when you combine the number of individuals who maybe haven't gotten so deep into the standard yet, compared with those that feel that it's going to have a cross-functional impact. I guess the key takeaway message for everyone on the call is to take advantage of the time you have and get started, because as you can hear from the other speakers so far, there's just quite a few impacts that companies will see really across their operation. For us in the technology, media, and communication industry, we really sort of look at our business across four sub-industry lines within telecom, software, high-tech and electronics, and internet and media. And as Chris Wright talked about earlier, this is all these sub-industries in particular are going to be impacted pretty heavily by these rules. There's specific industry guidance that has been out there for some period of time around software revenue recognition. That guidance is going away, and so you're going to see a lot of the software companies in particular taking a holistic and new view across the entire revenue model. There's been some discussion about the overall impacts at a high level, including reducing the number of bright lines, making it more principles-based, which grants organizations the opportunity to be more flexible when they think about their business model, the type of contracts they have, how they price products and services, what offerings, what bundlings they'd like to put together, and basically just a general increase in judgment and estimates, which, as many public companies have experienced over the last couple of years, you've seen the amount of impact that increased judgments and estimates have across Sarbanes-Oxley activities, dealing with your external auditors, and so on. So this is going to increase that area, which will be an interesting thing. There will be some increased complexity as you think about flexible models. As many speakers have said, this reaches much deeper than just the accounting activities of an organization, but also through procedures, policies, trainings, system impacts. There's quite a reach here. So shortly we'll hear from Mark Flournoy at Intuit, who can kind of give us the ground level view of what he's experiencing moment by moment as Intuit goes through this process. I guess maybe I'll just touch on a couple of specific areas, and Mark, these may have relevance for you and what you're going through in your organization. But if you look at variable consideration, it's certainly the impact of timing of revenue recognition is in play when you talk about milestone payments and contracts. You talk about service level agreements, refund rights that customers may have. All those things are going to build in, and when you try to look at the performance obligations and break apart the contracts, that variable consideration component will have a pretty big impact in most organizations. sell-in versus sell-through. The standard requires management to determine when control of a product is transferred to a customer. So as you look at those two different methods, there's a significant judgment factor that will come into play across, perhaps customer by customer. For those that sell through the channel, how does that impact rights of return and other factors that can have an impact in when control is transferred. So again, another area with a significant amount of judgment and estimates. A pretty significant change will be that the new standard for software companies around RevRec kind of eliminates or reduces the impact of VSOE thresholds and allows companies to really take a look at the best estimate they have for standalone selling prices for each separate performance obligation within contracts. So that's going to allow for probably quite a bit more acceleration of revenue, which has impacts really across the sales force, a variety of other areas. And again, just significant judgment when you think about breaking apart those performance obligations and assigning standalone selling prices. That'll be a pretty big lift and change for most organizations. Intellectual property licenses is listed as an area as well. Again, this is around when are IP rights transferred or when are they given change in control to the customer. That can be different, again, contract by contract, customer by customer, so significant judgment involves the type of license provided, timing of the change, et cetera. Those are just, I guess, a couple of high-level elements. Suffice it to say there's a pretty deep dive across the 109 pages of text here that impacts significantly this industry and the players within it. Intuit is, I know, Mark, heavily involved in the process now. You're leading that effort as VP, Corporate Controller, and Chief Accounting Officer. It'd be great to hear from you about how Intuit's approaching this, the players involved, and maybe what some of the challenges or words of wisdom you have to share with this group would be.
Sure. Thank you, Gordon. Can everybody hear me?
Yes, we can hear you well, Mark.
Great, great. I'm not sure everybody recognizes the name Intuit, but just to give a brief explanation of the company, Intuit is a consumer-based software and SaaS company. You may have heard of the products like Quicken, TurboTax, QuickBooks. These are some of the software and SaaS-related offerings we have that we offer primarily to consumers and small business owners. And the standard definitely has a big impact on the software industry as a whole. Specifically for Intuit, we've really relied on the rigor and the rules-based approach of 97.2 to really define how we modeled and developed our products and services. And as most of the consumer-based companies that are in the software space, you'll see that most of them are moving to the cloud. You'll begin to see desktop software, shrink-wrap software starting to decline significantly. You've seen it with Microsoft Office 360. We're in the same transition. And as you move to the cloud, you are looking for more of a recurring revenue model. It's a service-based model as you move to the cloud. And recently, over the past 2 years, our company has migrated to a recurring revenue model or a ratable revenue model under the guidance of 97.2 and 08.01. And we entertain both software RevRec and non-software RevRec within the elements of our arrangements. And we're definitely going to be challenged because we'd like to stay ratable. We'd like to stay on a recurring revenue model. And the new literature, fortunately or unfortunately, how you look at it, is going to position us with more revenue up front in some of our products and services. And we're definitely going through a process now of how we look at that change and that evolution as we go and move to the cloud, and how we have pulled more and more features off the perpetual license and push to the cloud, how that's going to impact that revenue model as we adopt the literature. Definitely a challenge. Software is one of the more difficult areas from my perspective, maybe because I'm living it, but it has a lot of challenges because of complexities of the offering. You're actually dealing with multiple elements that you have to assess at every minute, every day, depending on what the business or the strategy of the business is as they develop a product for their customer. One of the gentlemen, I forget, from Crane mentioned the concept of Excel, building these Excel models. We actually have offering matrices that we manage every day where we model out all the elements of any particular arrangement and have the accounting associated with it. So we're have a good foot already established with the implementation and understanding kind of obviously what we do today for each of these elements within all the different software and SaaS services we have. But we are down the path of trying to now start to again educate and implement these new changes, and there's a lot of variability in regards to how you do that. Gordon, did you want me to comment at all on how we're marching down the path for implementation?
Yeah, I think that'd be interesting, and especially to kind of underscore the point, Mark, of the organization's involvement beyond your direct reports to the accounting group itself. Would be interesting to hear.
Yeah, so where we're at right now from an implementation perspective, we're really out at the point of educating the entire organization, and it's not just the accounting organization, as has been said earlier. We're talking to our product management and product development folks. We're talking to our marketing folks, our customer care organization, our sales organization. As we look at the impact of the change in the accounting literature, we're working with them in some cases to even change the offering, depending on if it's still right for the customer to continue to get the same accounting outcome that we'd like to get. As I stated earlier, we're looking to continue to maintain a recurring or ratable revenue model. So involvement, education, documentation of what your offerings are, and education across the organization is critical as you manage the change. We're at a place right now where the education is just beginning. We've done an assessment, an initial assessment on some of our more impactful desktop software offerings that we have. We're now going out and starting to work with our product management and marketing folks and our sales and customer care folks on if we do make changes in the offering, how would it impact the customer? How would it impact how we have to market the product? Would it be, is it going to continue to get the same growth and revenue expectations as we try to drive down to the strategy of continuing to stay as a ratable revenue organization?
That's great, Mark. Very, very interesting. And I think, again, to underscore the time with the breadth of the organization, international impact, number of products, different business models. I mean, there's just a whole number of items to work through. So the involvement of the broad organization through education, through change management, and a variety of other things is obviously a key to the overall success. Mark, I think in the interest of time, I see that we're sort of at the mark. We might want to flip back over to the next poll question.
Great, thank you. Thank you, Mark and Gordon, and everybody else who has presented during this webinar. We are going to issue our 5th polling question, so it should be up on your screen now, and we are going to ask you for kind of a question that is assessing your knowledge on this new revenue recognition standard and how it will impact your industry. So on a scale of 1 to 5, rate your level of knowledge on how the new revenue recognition standard will impact your organization's industry. So that's one of the basically the major themes we've been talking about today, along with the cross-functional impact. So on a scale of 1 to 5, with 5 being the high level of knowledge and 1 being a low level of knowledge, how would you rate yourself when it comes to the knowledge component of the standard? So go ahead and answer this particular question. And where we're headed with the rest of the webinar, we've been receiving a number of good questions from the audience. We received a number of good questions during the registration process. So we're actually going to go into a live Q&A session so we can answer some of the questions we haven't already addressed to the content portion of the webinar. So we will get some deeper insights from our panelists in the next few minutes. So we'll give everybody a few more seconds to answer this particular polling question because this is an important one since it's the last one. We did administer 5 throughout the webinar. You have to answer 4 out of 5 to earn CPE for today. So make sure you go ahead and assess your level of knowledge. So we'll go ahead and show you the answers, and then I'll turn it over to Steve, who's going to start the live Q&A. And the majority of the respondents today said that they would rate themselves at the level of 3 knowledge. So 42% of you said that you would rate yourself as a 3 in that particular area, and the second level of knowledge coming in is number 2. So there's obviously a lot of work to do with this particular standard. It's a complicated one. We've talked about it just depends on what industry you're in, how it's going to impact you. So at this time, we'll turn it over to Steve, who will administer the Q&A portion of the webinar.
Thank you, Lark. I think that last slide certainly demonstrates that there's a lot that we are learning and know, but there is a lot that we don't know. One of the questions that comes up, and I'll address this to Chris Wright initially, and certainly others of you can weigh in on it, but the question came up was that this is the first principle-based standard we've had in the U.S. For forever. This is going to be a first time through for a lot of different people, the company, its board, analysts, others, for first time through for the external auditors. So, Chris, I guess as you think about this first time through, maybe as it relates to external auditors and other advisors, what advice would you give to this group about how you should involve those various stakeholders in these discussions?
Steve, thanks. I appreciate the question, and we have been getting questions on this and getting some good and best practices from some companies that are in the process. The first thing I think everybody should do is just have a dialogue with their external auditor about timeline. Now, they're not part of your decision-making process directly, but if, for example, you're planning on adopting retrospectively versus prospectively, they may have a view on how it is you'll go about auditing the 2 older years that you're going to present one way the first time and then differently the second time in terms of what you need to gather, preserve, or create to make that audit possible, or whether you're auditable at all. They are going to have a view on things as they evolve, and the second thing you might want to do is understand what their training timeline is going to be so that you can be interacting with their staff, the staff that's on your audit, in a way that is subsequent to the training, not beforehand, so that you don't have any do-overs. And it's important to involve them in some of the key decisions beyond retrospective or prospective, or for example, early adoption. Would you like to go on 2017 instead of 2018? And do they think you'll be ready? And are they of the same view as you on that? What you don't, all to avoid saying one thing to an audit committee meeting and then having them say something different in the executive session right after you. We think it'll be important to have touch points with them, even if you think that there's no impact. If you get to the diagnostic and you've got a relatively straightforward ship and bill scenario where there's not going to be much to change and you've gone through all the level of effort, you want the decision that nothing has to happen or very little has to happen to also be a group decision so that you don't get down the road and have them disagree. It's really all about key points of contact and scheduling that and asking them for their feedback as the process unfolds, and time it along with their training so that you're having an educated conversation.
Thanks, Chris. Curtis, Mark, or Jeff, any observations from living this day to day and dealing with these stakeholders?
Not for me. I'll just echo. This is Curtis. I'll just echo Chris. No surprises is always the best approach on our end. So keep those stakeholders close.
Yeah, you got to. From my perspective, this is Mark Flournoy. I think you have to work hand in hand with all of your stakeholders and your external auditors. As a company, we're working with other various companies in Silicon Valley right now to go back and continue to work with the FASB on having the FASB provide more examples for the software SaaS space on how we're going to look at the new literature And I bring my auditors along and the company and the key folks within the company along all the time as we start to get ask those questions, as we start to model out examples and see what the possibilities are. I recommend doing, as you're doing the assessment too, and looking at your different offerings, take some of the more problematic offerings and work directly with your external auditors and have them flesh it out and see if they agree with your position. Doing that through this process is absolutely critical.
Thanks. So one of the things you guys just pointed out was this transition method. And a question came in that said, why wouldn't everyone just default to not the retrospective, but the prospective or the cumulative effect method, because it would save you all the work related to restating or recasting the prior years prior to adoption. And just off the top of my head, I certainly think that if you knew that others in your industry were all going to use the retrospective approach, or you found that using the cumulative effect, by doing so, there would be revenue that potentially would never be recognized in your statement of operations, but it would simply go through retained earnings as a cumulative effect. I think that would be a couple of things to consider, but maybe Chris, other thoughts that you might have as it relates to thinking about this transition method, and it might be a more difficult decision than people think.
Yeah, and so Steve, as we've interacted with companies who are getting through the process, we have found that to the extent that they think it'll be material, they're also relatively focused on doing it retrospectively, just because of the very idea of having revenue that essentially never gets recognized isn't sitting well with the folks who do investor relations and modeling and forecasting. They also believe that even if they did do a cumulative catch-up, they would have to, for some pro forma or presentation or trend purposes, have the data anyway to show what the revenue would have been like, and then that runs them into the non-GAAP pro forma presentation issues that they'd like to try to avoid. So we're seeing most folks for whom this is expected to be material also focusing on retrospective adoption for the 3 years. Obviously, the SEC has taken the other 2 years of the 5-year table off the table for everyone to the extent that they've been heard on the issue. But we think retrospective does seem to be where people are headed.
Pete, one of the things you talked about was a module that SAP has developed or continues to develop. And I guess the question, I'll let you respond, Pete, but are we seeing ERP Tier 1, Tier 2 providers developing modules and solutions that are going to make it easier for companies to adopt this new standard, and realizing that even in the existing rules, it's been very hard to find a off-the-shelf, if you will, product that you can plug and play, a fair amount of customization and manual workarounds. So, Pete, what are your thoughts about using technology as an enabler, and what might be coming from that industry?
So the answer is yes. I mean, from an industry perspective, there is quite, I think, a good amount of activity. I mean, there's several vendors. Obviously, many of them are our competitors that are working in the space, from big ERP to smaller cloud providers. From the SAP perspective, we've actually been working on the product that we have. It's called SAP Revenue Accounting and Reporting for about 5 years. We actually, back in the early days when we had some exposure drafts and kind of the early papers in 2008 and exposure draft in, I think, 2010, we were looking at the whole new 5 steps and the impact on the architecture for the solutions. And we decided we needed a new architecture, that in order to best solve this problem, you can't really retrofit a solution. So we took a clean sheet approach. We think are unique in that, and we're building the product from the ground up to address not only the new standards but the current standards. And by doing that, we think we'll be able to solve some of the challenges that some of the ERP vendors have had in the past in trying to automate this area in a cost-effective manner. So that solution now is in the marketplace. It came out early this year. We've got customers rolling out, some initial customers, and there's more roadmap or product to be delivered. We just finished testing on our 1.1 version, and that will come out later this year, and another version, 1.2, essentially is already started development work on. So I think you'll see much better availability of this as we get into the second half of this year and into early next year.